We've talked about like the scary stuff. We've talked about insurance, and we've talked about legal documents. Those are like all traditional ways of managing risk. What I will say, the non-traditional and like other thing to consider and think about is that through any of these tragedies, what is often at least as valuable, if not more valuable than checking the boxes on the insurance stuff, is your community.
Hey, it's Samantha Hartley with the Profitable Joyful Consulting Podcast. This season, we're talking about empowering women. And today I want to talk about empowering you to be better with risk, taking better risks. We're going to talk about the 5 biggest risks that we encounter in our businesses and what we need to do about that, because we need to be smart about risk. There's so many times we're taking a financial risk where we're investing in something and we don't know how that's going to turn out. And there are certain risks that are probable, maybe unlikely, but probable. And there are 5 particular ones that we will discuss in this episode. You know people every day who are your work colleagues and they get killed. I'm sure you've heard about people who died of COVID, or who people have an accident while traveling. And there are all kinds of situations where people who are our peers, not super old and elderly, but our peers who die. There are people who get injured and are unable to return to work. Just this week on Facebook, I read about a Facebook friend who had an accident and has been in the hospital and has been away from Facebook. Why have I been away? Because of this. So all kinds of things can happen. 2 years ago, I was diagnosed with Lyme disease. I have a version of it, which is not as severe as some of my colleagues have had, but I have known someone who was unable to work since basically the time I've known her because of the version of Lyme disease that she has, the kind that it makes it impossible for her to be functioning in her work. And if that kind of thing had happened to me 2 years ago, I wouldn't be able to be running my business today. Those are risks that we can anticipate, just as we can anticipate that divorce happens 50% of the time, or you could get sued, a client could fire you, or you could go out of business. There are things that we can prepare for in our business. It's not super fun to talk about them. So what I do is I invite on somebody that is super fun to talk with about these things. I've invited back one of my favorite guests, Jen Sapel, who is going to talk with us about how we can manage these risks in our business, in our lives, and to do so in a way that isn't just darn depressing, but is actually like empowering, perhaps. So let's meet Jen. Jen Sapel is a recovering type A who grew up in a home that was financially unstable post-divorce. She founded Utor Wealth, that is Latin for enjoy, to show high-earning women how to enjoy and be confident in their financial decisions. And that is exactly what we're going to talk about today. So I hope you enjoy my conversation with Jen. Jen Sapel, super excited to have you back. You're our returning champion. Would you please tell us a story that will give us a context for the topic of risk that we're going to talk about today?
Sure, I'd love to. I'm going to tell 2 stories, if that's okay.
Yeah.
The first story is of a cardiologist, specialist in his field, cardiothoracic surgeon, no less, who developed a health issue and could no longer practice medicine. Fortunately for him, an insurance agent had come to his residency program and encouraged everybody to sign up for disability income insurance. So that is insurance on your income specifically, your ability to earn an income. And since he can no longer practice medicine, he had insurance that replaced his income. And that particular kind of insurance and that risk in general, I would say, is probably the most overlooked risk in personal finance.
No, I'm making a face about it because they keep talking to me about it. And now that you've said it to me this time, I'm going to have to do something. All right. That was a great story of how he narrowly avoided a disaster. So you have another story?
The other story is of a business owner whose 16-year-old daughter, terribly and unfortunately, driving, hit a pedestrian and severely injured the pedestrian. That resulted in a lawsuit against the family and a multi-million-dollar legal settlement. So those are, again, that's a risk story. And that legal settlement, like that was millions of dollars that they ended up being liable for beyond what their car insurance covered. So their car insurance was their first line of defense, but beyond their car insurance coverage, they were personally liable for millions of dollars. And that either comes off your balance sheet, or, you're paid out of your cash flow over, your wages can be garnished, things like that over the course of years.
Okay. So hold on, I just need to slow that down. What do you mean their balance sheet? Like, where did that money come from? They just got a bill that said you now owe millions of dollars. And then what do they do?
So depending on the state you live in, it's a creditor. So a legal claim is a creditor. And depending on the state you live in, there's laws that say creditors can garnish these assets. And these assets are protected. So as an example, like, you've mentioned a family member who's in life insurance. In most states, assets inside of a life insurance policy are creditor protected, meaning if you've got $100,000 of cash value sitting in a life insurance policy and you had some kind of legal creditor issue, like I just described, the creditors cannot lay claim to that life insurance policy. They can to your bank accounts. If you have that $100,000 in a savings account that is not creditor protected, they can say, you've got $100,000 in a savings account, you owe us $2 million. We're going to need that $100,000 and then installments on the balance of the rest.
All right. So our topic today is scary risk, things that can happen to you as a business owner. And as women, I want to remind everyone that we're talking about how women can empower themselves and guard against these kinds of just scary risks. So that illustrates two of them, right? Mm-hmm. The risks. What are the other really big risks that can happen?
So the good news about risks is that there are only a short handful of them. Death is one. Disability, like I mentioned with the physician. Divorce. Mm-hmm. Unemployment, and lawsuit. So those are the 5 major risks. If you're a business owner and you have a partnership, like I'd couch that under divorce, just in terms of like risk. A breakup, right? A separation. Those are the 5 major risks. And I think a lot of the issue with us addressing risks is that we kind of live in a culture of perpetuity. Like our default setting is we think that things are just going to go on forever as is. Like that's culturally and neurobiologically, that's kind of how we're wired. But one of the best things we can do for ourselves is just sit for a moment and acknowledge that all things end. So all relationships end, all businesses end, like nothing lives in perpetuity. So it's not about being afraid of risks. It's not about avoiding risks. It could be about managing risks. It's more about being prepared for it to end, however it might end.
Mm-hmm. Good. So I want to delve more into that as well. And before we do, let's just back up and learn, like, did you have a particular risk? Like what sent you into the work that you're doing now?
Great question. The work I started in financial services at an insurance company.
Uh-huh.
And all insurance companies do is measure risk and pool risk, right? So all insurance policies really are pooled risk. They're preemptive GoFundMes. Right? We all pay a little bit into the bucket so that when one of us needs the bucket, that's what insurance does. So that's how I got into this realm.
Good. Fun. And so what's the best place for us to start thinking about this? Like what do we need to be doing right now so that what's the first risk we need to think about, and what is the best way for us to approach it?
Beautiful. Okay. I like to approach the risks in terms of what's their likelihood. So the most likely risk that we just described of the 5 is death, right? Okay. Because we are all going to die, whether it happens tomorrow or it happens when we're 100. Mm-hmm. And then to manage that risk when it comes to finances, we really just need to ask ourselves, who depends on me financially? Financially tomorrow, if I hadn't come home yesterday, what kind of financial impact is that going to have on business, on my clients, on employees, on my family? Mm-hmm. And the 2 things, and for most risks, for like most of the risks we're going to talk about today, the 2 mechanical ways to manage them are usually through insurance, any kind of insurance, or through legal documents.
Okay.
contractually. I'll pause there. Does that make sense?
It totally makes sense. And I think you and I have talked about this, that my husband and I a couple of years ago just had this kind of moment of like, well, I guess we got to be grown-ups and we need to like have a will and we need to like do this certain things. And I brought in this finance firm, and we just went through the list of like the things that we need to have in place. And I think that one of two things prompts this mature light bulb moment that I had, or a bad thing happens to someone and it scares the crap out of you, and then you suddenly scramble and do something. So what I want this show to be for our listeners today is that opportunity to be like, don't wait, like the disability story that you just told. I don't want to wait until like a bad thing happens before I say, actually, I probably do need disability insurance. For me, of all of the 25 kinds of insurance that we already have, that is one that as a business owner, I need to think about, because that's affecting me. So again, I feel like it's easy for people to listen and be like, well, that's covered through my spouse's company, or that's my whatever. Well, all of us are business owners. And so there are certain things that we need to do as business owners, and sometimes head of household or just responsible individuals, to make sure that these things are taken care of. So that's really why I wanted to delve into this. So I did not think that death was going to be the place you would start, but it is, as you're saying, important that death is going to happen to us.
Yeah, so the way that my brain works is I like to organize and categorize things. So I'm like, okay, we're going to categorize them from like most likely to least likely, and then like catastrophic, like biggest impact to smallest impact, and then like what's the ease of handling it? Like how do you handle it? With with the life insurance, with death as being a risk. Life insurance is one of the mechanisms. It's really easy to take care of financial issues around it. I remember really early in my career, I sat at a table with a young couple with young kids. He worked full-time and was a stay-at-home mom. And I remember he was giving me a lot of pushback saying, I don't need insurance on her. And I was like, just because she's not earning an income doesn't mean that she's not contributing economically to this house. So you have to hire a babysitter, right? Like all the things that she's doing, you would have to hire out. And those, like, let's talk about how valuable those things are. Right. But you brought up the other really important thing is, even if there's no financial impact on a death, where does your stuff go? What do you want to know? Who do you want to get what? And what do you want people to know about you when you're not here anymore? So a level, healthcare directives, powers of attorney, all those things are important too.
Definitely. And I think that's the key thing, is that knowing that it's a really simple document that can save you. It can save your family and your heirs, like whoever that is. I mean, unless you're like a completely solitary person, you don't have anybody who is involved in your life. You want those people to have an easy time if something were to happen to you. And by the way, I have known, and I feel like for a lot of us who are in business, like we've known people who died. Yeah. Like other business owners, like I have colleagues who died, and it was shocking. Right. And you feel like they're going to be alive forever, but this kind of thing happens. There was speaking of nightmare stories, we could go on and on with those. So that is what a big one. So what's the second likeliest thing to happen that we should be prepared for?
Divorce. Mm-hmm. So we all know the stat that 50% of marriages end in divorce. And again, even if your marriage doesn't end in divorce, your marriage is going to end eventually, right? So it's usually either through divorce or through death. But you've got a 50% likelihood of that happening. And what I tell my clients when it comes to preparing for divorce is that you already have a prenup. There's kind of this like resistance to getting a prenuptial agreement, because it's identifying that like, oh, maybe this isn't forever. Maybe this commitment I made isn't forever. But what I'll say is you already have a prenuptial agreement. The state you live in already has laws that say this is what's going to happen to assets if you guys part ways as a married couple. And so you have a default based on your state, and you want the state of Washington, in my case, right, to decide how to divide your assets in the event of divorce. Or do you guys want to have a conversation about it now while everybody's happy, while everybody's healthy, and say, look, if this doesn't work out, this is how we're going to manage.
And do you feel like the stickiness of the money piece prevents people from having that conversation? Or is there like, I feel like if people fear that they might have a catastrophic fight before they get married, like maybe that tells you something about your relationship. But anyway, I think the action step from this is, for me, is like find out what the state of Massachusetts thinks about divorce.
Yes.
And then look into that. And no matter how blissful we may be. For business owners uniquely, what issues can come up around a divorce?
Yeah, so the businesses, like marriages, can end for a variety of reasons, and not all of them we can foresee. But I don't, like you probably have stories like this too, Samantha. I've seen in a marriage, I've seen a spouse, become terribly addicted to drugs and dependent on drugs, and that had a significant impact on the marriage and on the children. I've seen that happen in businesses too, right? Where a business partner, for whatever reason, right, substance abuse comes into play. Now they're not showing up for work at all. They're not contributing to the company, but they've got an ownership stake in the company. So there are lots of things like that. An owner can become disabled, and again, can't contribute to a company. So it is just a matter of having a conversation and being prepared. If for some reason we need to part ways, whatever the circumstances are, we need to part ways. How are we going to do that? What are the steps and what are the mechanisms that we're going to take to do that? And sit down with an attorney. Again, that is a legal document. It's usually called, like, your operating agreement should address some of that. But if your business is something that has value, if you could sell your business tomorrow, a buy-sell agreement is kind of that legal document that says, okay, if either one of us needs to buy the other person out, what does this look like?
Okay. So if let's say business owner Amy gets divorced from her husband Jeff, what does Amy need to do to protect the business from Jeff? And like, how does that kind of shake out?
That's a really great question. The best way to address that is when you're establishing the business on the front end. And again, this varies state by state. So the state of Washington, for example, is a community property state. So I, as a business owner who has an LLC, I had to state explicitly in my operating agreement that the LLC is mine solely and completely and is separate property from my husband. In the state of Washington, if I had not done that, the assumption under the law in Washington is that my LLC, he is a community property owner in. So again, the best way to address that risk is to do it when you are establishing the business. If you have to do it after establishing it, that's fine. Consult with a legal counsel and figure out what your options are to delineate that ownership and that risk.
Interesting. I don't know that was obvious to me that would be the way that shakes out. Cool. Okay, so that's divorce, whether a personal divorce. Okay, in a business divorce, you talked about a buy-sell agreement, which I think is super valuable and important because I have seen several of my clients who had consultancies, meaning it's not just a single person. Either there was a duo or a little trio or several, like 5 principals who work in the company. And I've seen those breakups happen where now we have shared assets to divide, but also sometimes there's shared debt that has to be divided. And that can get into a big mess because it's just like co-signing on a loan for your partner who then defaults on it. So that's a really important thing to kind of look into when those partnerships are being formed. And I feel like a lot of partnerships are just kind of casual, kind of like a common law marriage.
Yeah.
And I think this is the risk is that it could go badly just as with an official marriage.
I love that point. I think people avoid, we like to avoid talking about risks, and that's normal. That's like a self-preservation kind of mechanism for us. But to think about the risk of not doing this, a lot of times is a much bigger risk than the risk of sitting down, same with the prenup, than the risk of sitting down and actually addressing it now. In businesses, you and I are business owners, so we know when businesses first start off, they're messy, they're hard, right? it's a steep curve on that first part of businesses. So if you're in that phase of business, I'd say like it's really normal to not be addressing those things on the front end. And that's okay. If you don't address them on the front end, you get to a point where, okay, now revenue starts to come in. You get to a point in your business where it starts to be in growth mode. That's the time. Like, let's address it as soon as possible, right? Sooner is better than later. Let's go back and clean up some of these things and address those risks.
It's funny because when you describe it that way, it sounds like the exact opposite of the way marriages start. Like a marriage starts with this like, yay, everybody's in love and everything's going great. And then it starts to kind of evolve into, oh no, what have we done? And then with a business, as you're saying, like it starts like, oh my God, what have we done? This is really, oh, hang on, it's good. Hey, it's pretty going okay. And in both situations, there's going to come a time when you're going to want to think about something. And it's going to be the opposite of when you think it.
Yeah, that's true. That's true. And actually in my experience, that's that progression, and same with the marriage is like you talk about all these things before you get married. And with businesses, you don't talk about any of those things. You just worry about surviving, and then things start to get good, right? And then you just end up putting it on the back burner. Yeah.
Do the hard things when you don't think you should be doing the hard things, I guess would be the lesson from that. I also feel like that's the good role of these scary stories that you tell. It is important to scare the crap out of ourselves occasionally so that we can say, hey, stop delaying this. Don't delay this another day. Because like the day before, you hear that. That's why I always knock on wood. I'm like, now that I've heard that disability story, I feel like, guess what? And then you knew you should have done it. And then, you plan nonsense like that. So that's helpful. Okay, so we've done two of the risks.
Before we leave buy-sell agreements, though, I do want to say one of the biggest mistakes I see in this arena. So if you get a buy-sell agreement, we say, okay, yes, this is how we're going to value the business, and this is how we're going to pay the other person off. I'm going to have first right of refusal, all of those things. You create the legal document. The next step is to fund the document. So again, life insurance is one of the easiest mechanisms in that realm. So that is like, if somebody dies, how am I going to buy that half of the business? If the business doesn't have that cash sitting on hand, like where's the money going to come from? Through insurance or otherwise. Make sure you're addressing how you're actually going to write those checks under any of those contingencies that you outlined in the buy-sell agreement.
That is such a great idea. So, okay, so let's play this out. I'm in business with Amy from the previous example, and I have a thing that says I can buy out Jeff.
Yes.
This is before they're divorced. I can buy out Jeff in case Amy dies.
Yep.
Do I take out insurance on Amy? How does that work?
Yep. So if you and Amy are a partnership, there's a lot of ways that you can structure it, but one of the ways you can structure it is a cross purchase. So you buy insurance on Amy, Amy buys insurance on you. One of many ways that you could structure it, but that's one of the simplest ways.
Great idea. So then something happens, and then I have insurance money to give to Jeff on top of his life insurance he probably had on her. And then that way, because I've always used this example of, I don't want to be in business with Jeff.
Right.
I wanted to be in business with Jeff. I would have started the business that way. And again, I've seen this situation with people before where they're like, oh, great. Who's this person?
Yep.
And that's because, well, this is what came with the deal. Only you weren't clear about that at the beginning. So, okay, well, that's super helpful and a great addition.
Mm-hmm.
All right. So what's our third big risk?
So we went death, divorce, now is disability.
Okay.
The stats on disability are shockingly high and only getting worse because.
Yeah.
So we have in our adult working life, there's a 1 in 4 statistical likelihood of having a long-term disability. A long-term is lasting 90 days or longer. And I've seen this where I've seen disability come into play. I had a hygienist who, that hygiene work where you're constantly using your hand and your wrist. Massive damage to her hand, couldn't practice anymore. The cardiologist ended up having a chronic illness. I've had another physician client who was diagnosed with ALS in his 50s, and he, like you talked about, he as a physician knew he needed disability income insurance, he needed long-term care insurance. In his head, he put it on a future to-do date. He was like, I'm going to obtain that insurance in my mid to late 50s, and he didn't make it before he needed it.
Okay, so quick point. The business can buy, that's a business expense, right? Disability?
Yeah, that's a sticky question. So yes and no. You're gonna want to consult with both your insurance agent and your tax person. Here's the difference. So if you're a solopreneur or sole proprietor, you can buy disability income insurance. So remember, that replaces your income. It's insurance on your income. People, when I say disability insurance, a lot of times they think of medical insurance.
Right.
Medical insurance pays for your medical expenses. Disability insurance just sends you a check monthly to replace your income.
So whatever your actual income was.
Yes.
You find it is another reason you should pay yourself an income from your business.
Amen. Absolutely.
This is official income. Okay, good.
Yeah. Yes. You and an insurance company will only insure documented income. So you can have a bunch of revenue from your business, but if you're not taking earned income from your business, you can't insure it either. Yep. So another reason to pay yourself a salary. You can't insure 100% of your income. Insurance companies don't want you to have an incentive to get hurt or injured. But you can insure 60%. You can get really creative sometimes and get up to 70 or 75%. But here's the difference between writing it off as a business expense and not. If you buy disability income insurance and you do not write it off as a business expense, then if you become disabled and that insurance policy pays you income, that is tax-free income to you.
Got it.
If you write it off as a business expense, if you're taking that deduction as a business expense, then the income that you receive if you become disabled is taxable income to you.
So helpful. Really, really good difference.
Yeah.
Okay. Noted.
Yeah. So it's and again, like how you want to handle that is both up to your preference and what's available to you and, within legal, state, insurance, all the regulatory guidelines.
Yeah, exactly. Not financial advice. Your mileage may vary.
All of those things.
Yes. Got it. Good. Okay. Well, that's super, super helpful. Yeah. And again, I feel like this is another good example. Like literally this morning or late last night, I saw somebody on Facebook being like, hey, here's why I haven't been on in a while and there were two different ones. And one was like a mental health one and one was somebody had an ATV accident. And I'm like, both of those are extremely likely right now as reasons that somebody might not be able to work in their business.
Yeah. Spinal. So what you just like statistic likelihood, the number one claims are like musculoskeletal issues, usually like a back injury, right? Like my back is out. I can't sit at a desk. I can barely, just be without pain. And then mental nervous disorders is what insurance companies call them, but like anxiety, depression, things like that, where, you can't function, you can't work, you can't be employed. Those are up to reasons for claims.
And I feel like it's so tough because a lot of the reason that, one of the reasons I left the corporate environment was because of that latter reason. I was like, I cannot work in that environment anymore and be a healthy person. And so I think a lot of people who, this is just, it just is the situation. And I don't want anybody to not be able to honor a mental health need because they have to keep working because otherwise there's no money. So
that just exacerbates, right, all of it. It's being compound issues. Yeah.
And we don't have the kind of jobs as consultants that we can afford to be not at our best when we're doing these jobs. So, okay, super valuable affirmation that disability is something for us all to look into.
Yeah. And people, before we leave disability, people usually get a little sticker shock when they see how much disability income insurance costs. And I'll remind them, your car insurance covers your car being totaled. So like, what's the value of your car? Like it's a $30,000 car, it's a $60,000 car, it's a $100,000 car, right? That's what it costs to replace your car. Think about your annual income, right? So if you're earning $100,000, you're earning $250, like whatever you're earning, that every year, that's what they're insuring. And so proportionately, it is, it's the insurance companies crunching numbers and measuring the risk. And so don't get sticker shock, right? Yeah. They're insuring a big amount. That's why the cost is high.
Yeah, I think that's the thing is that it is expensive, and that's a reason to put that one off. Whereas I think that some of the other things that we've talked about aren't as expensive to do, but that the cost of that insurance is high. And it's like, well, okay, so how lucky do you feel?
Yeah. Yep. And just so people have an idea, like you could pay somewhere between 3 and say 6% of your income to insure your income. So if you're making $100,000 a year, then $3,000 a year is going to insure that $100,000 a year, right? Or $6,000 a year. And you could structure the policy differently. There's lots of different ways that you can, modify and get a right fit for you, but just so people have, an expectation.
And it should just be more than zero, so that when if you're out of work, then it's not like there's nothing.
Yeah. Yeah. Going from making 6 figures to making nothing is a transition that most people can't manage. But going from making $100,000 a year to $60,000 a year isn't fun, but it is a lot more manageable.
And I also think it's really realistic for our kinds of businesses because for consultants and other expert businesses, like you are the business.
Yeah.
This isn't like the factory could go on without you because somebody steps into your job and does it. This is like, if you can't do the work, you can't be attracting the clients, you can't be fulfilling the work. Like there isn't going to be anything happening. And so this is a portion of something.
Yeah. Yeah. And I as an advisor and you as a consultant, we literally get paid to talk for a living, right? Yeah. We hop on these calls, we hop on podcasts, like we're giving advice. Like our verbal communication skills is what we get paid for. A couple weeks ago, I had to get a biopsy on my thyroid. And as the doctor is sitting there, stabbing my neck with a needle, I was like, my throat was hurting and it was swollen. And I was just thinking, like, if I can't talk, can I work? Like I could probably like find accommodations and things like that. But like I could take a significant hit in my income if I were unable to talk. That's a big risk for me.
It's going to be a lot of adaptation from there, for sure.
Yeah. But I have a huge, everything's okay. Biopsy came back fine. And I have a robust disability income insurance policy. So, and I thought of that. I was like, well, at least I have disability insurance.
For real. Good. I mean, a lot of my clients are breadwinners and their families. My clients are women consultants who are breadwinners and their families. And it's not that they're not necessarily that there would be nothing, but they're, I want there to be something for sure.
Yeah.
Good. Okay.
Unemployment.
So for a consultant, what does unemployment look like?
Yeah, good question. I and even just unemployment as a risk in general, I think is better prepared for and couched as what's your freedom fund look like? And especially for self-employed people, I don't know if you see this a lot already, but I would love for us all to be structuring our businesses so that like we're only working as much as we want to and not any more than that. Which like, does that mean we're taking 2 months off every year, 3 months off every year? So unemployment is just being prepared for, you can fire any client, right? And not have to keep the pain in the ass client just because you got to pay the bills.
Right.
It means you can pivot. Like if you just get burned out on whatever your area of expertise is and you need to pivot, you can give yourself the time to pivot. I think that's a better, even if you're suddenly unemployed, I've had lots of friends and colleagues get laid off from big tech jobs in the last couple of years.
And or your client, your contact at your big tech consulting company just laid off everybody, and so that engagement that you thought was going to be a year isn't a year.
Yeah,
and people get fired from contracts before, whether through their own fault or because the client changed their mind. Like as you're saying, all kinds of things can happen. Yeah, I call this like financial freedom or financial independence. It's really the having enough money to be able to be at choice with what you're doing. And I see a lot of other people writing about the economy, this and that, and like what's coming up in the fall and things like that. And I feel like, well, I make my own economy.
Yep.
So I think what you're doing is speaking to the way in which we can make something like that be true.
Yep. I'm 100% aligned with that. And from like a practical expense standpoint, I like your business operating expenses, like 3 months in there, 3 up to 6 months, right? Then you've got that on hand. If you've got contractors that you want, right, to keep on as contractors or whatever the case is, from on your personal balance sheet and personal finance side of things, I really like in this world to be in like the 6 to 12 month range, that like you could pay all of your bills for at least 6 months, if not 12. And it's both the in case of emergency, in case of a pivot, in case of all those things. And it's an opportunity fund.
Yeah.
A couple years ago, we had our opportunity fund was big, and we got an opportunity to buy a rental property at a great deal. And like we had the cash on hand to do it. So we did it.
Great. I'm really glad you bring up that point, because I do know I have talked to clients before about an opportunity coming along and like talking about how to fund it. And I'm like, well, here's our choices. You can go and get a client and say that you want them to be like $55,000 because that's exactly what this opportunity is, or whatever.
Yeah. Other ways. Yeah.
Happens. But again, like being able to be at choice with an amount of money is really great. And again, when at the beginning of COVID, we went, okay, hold on. I was like, I had no idea how long COVID was going to go on, but I just thought, okay, this is a horrible thing. And let's just make sure that we have this money liquid and, that we can have access to no matter what. So, 12 months is a long time, but I think 6 months is 12 months is a good goal, but 6 months is a good minimum.
Yeah. And wherever you are is perfectly fine. Just make a plan, right? To get to a goal, whether it's 3 months, whether you're starting at 1 month and then you go to 3 and then you go to 6.
Yeah. Good. Awesome.
And then the last one is lawsuit.
Right.
So business, like general business insurance, general liability insurance. Again, insurance is the best way to do this. The likelihood of this is pretty low. So like a personal liability suit is like a 1 in 10 chance. And most of the time that happens because of a car accident. So again, like hitting pedestrians or hitting cyclists or things like that, those are the most common occurrences. Minor children, like the story that I started with, huge. Yeah. And minor children, whether they're driving or not. If your kids they have friends over, and I've actually seen, I saw an x-ray of a softball game where the coach got hit in the forehead with the ball, and you could see the indent in his forehead of the ball. You could see the print. So it fractured his skull and his orbital. All of that would be covered under like that specific injury is covered under your homeowner's liability policy. Interestingly enough, if you run over somebody skiing, if you hit somebody on the golf course, all of those are covered on your homeowner's insurance.
Interesting. Under the umbrella policy, right?
So your homeowner's insurance first, yes. And then the best thing to do on top of that is have an umbrella policy.
Okay. Got it. And how much is a good number for that?
Umbrella policies are generally sold in $1 million increments. So really common for, and I would just say good best practice for everybody to have at least $1 million umbrella policy. And then depending on your net worth and your income, and your potential income, you can get them up to 5 million. I've seen them as high as 10 and 15 million, but it really just depends on how much assets do you have to protect. You're not going to be able to get an umbrella policy for a lot more than, kind of what your net worth is, or your like prospective net worth is over the course of the foreseeable future.
Got it. Okay. And then as a business owner, so I think like errors and omissions and things like that happen. Doesn't an S corp protect the business from things in a certain way?
Yeah. So good call out there. The other way, so insurance is one of the mechanisms. The other mechanisms are the entities. So whether you could be a sole proprietor. If you're a sole proprietor, but you operate under limited liability company is literally what LLC stands for. And what that is saying is that you contain all of this activity inside of this entity. So if you're sued, only this entity is what can be, garnished, what can be accessed in terms of taking care of this claim. And that's where like a lot of businesses just end up going bankrupt or something, similar. So any entity like that, will be its own container for that risk. That's why if you own rental properties, owning it inside of an LLC, same. So something horrible happens on your property, somebody passes away, they can sue you as the landlord. If it's in an LLC, they can only sue what's in the LLC. They can't also come after what's on my personal balance sheet.
Got it. Okay.
And then we talked about that lawsuit with my business owner client at the beginning of this. Your personal balance sheet. So there's, again, depending on the state you live in, things on that balance sheet that would be subject to creditors and things that are not. So there are things that you can do even on your personal balance sheet, whether it's own assets in entities or insurance vehicles like life insurance, where you own, how you own an asset, where you own it, what type of account you own it in. Those also have the possibility of limiting your liability to creditors.
Okay. So if we can walk through a few examples, let's take Amy, our consultant. Let's say she makes a mistake in the work, or the client believes she does, and they want to sue her to get their $100,000 that they've paid her back. Mm-hmm. She only has $20,000 in the company right now. Where does that other $80,000 comes from? Future work, assets through the business. Could she just LLC? Like how much? What's the limitation there?
Yeah. So I'm not a lawyer, and this is legal advice. But my hunch would be in that case, if she is found liable for the full 100,000, so that they would have to use the legal process, and come to that agreement. But if she is found liable for that amount, so 20 can come from the business, and then she owes a balance of 80. And so she's going to have to pay off that 80. They're going to have to come up with some kind of way for her to pay off that 80.
Mm-hmm. Okay, so let's do the recap and then the action list from this. The 5 risks are, in order of likelihood: death, divorce, disability. What was the 4th one? Unemployment, which for us is going to look like getting fired by a client, or in the positive, it could look like what you're calling a freedom fund, which I like. Your sabbatical fund, your opportunity to be at choice and do whatever you want with your money. And then the last one is a lawsuit, which is not unheard of. Yeah. I think a lot of us know, and can be super scary. So what's the action list for our listeners?
You take one at a time, or you could take all 5. But for almost all of these risks, it's an attorney. It's talking to an attorney and saying, I want to address these risks, and tackle them one at a time. And it is insurance. Life insurance and disability insurance. You're going to talk to a life insurance broker to manage those things. Umbrella insurance, some of those other types of insurance we've talked about today, is going to be your insurance agent, your auto and home insurance agent. Sometimes those are the same people. Oftentimes they are different people. Commercial insurance, for the business stuff. So all 3 of those are kind of their own specialty. So there might be 3 different insurance professionals. But I'm sorry, what were you going to ask?
I was going to ask, well, where can people find out more about you and what you help with?
Oh, thanks. So I help with a lot like this, just like the overall financial life and structure and protecting yourself and your future. So that kind of strategy. And I am licensed for life insurance and for disability insurance. It's not the primary part of our practice, but because we're helping people with, with their totality of their financial life, it is kind of a auxiliary service that we provide. So, and I'm happy to answer questions about them. So if your listeners have questions, schedule a fit call with me. I think it's 15 or 20 minutes, and I'm happy to answer individual questions.
Perfect. And we can find you where?
utorwealth.com, UTOR wealth.com. I'm Jennifer, and 15 minutes is free. I do want to say one other thing before we sign off. We've talked about the scary stuff. We've talked about insurance, and we've talked about legal documents. Those are all traditional ways of managing risk. What I will say, the non-traditional and other thing to consider and think about is that through any of these tragedies, what is often at least as valuable, if not more valuable than checking the boxes on the insurance stuff, is your community. So having robust relationships, having people you can count on when things get hard. Yes. Don't underestimate that. I would say that is just as much of an investment as any of these other things that we've talked about today. So if you're listening and it's been a while since you've reached out to your friend, this is your cue. Call your friends.
Absolutely. Love it. Love it. I completely agree with that. And it really is, to me, the piece that makes us empowering women isn't just with information and with financial and legal tools. It is also with community. That's how we survive. It's thrive and survive. Yeah. It's through that community and those support systems of relationships. So thank you so much, Jen. Super, super informative. Really loved hearing about this. And with that, Jen and I are wishing you a profitable and joyful consulting business.
Thank you.